Okay, hey everyone. So I wanted to record a real quick video on what it looks like when you are trading a credit spread and you get assigned. So you can see I got this email this morning. It says option assignment alert, immediate attention required. And if you've never gone through this, this can be somewhat kind of nerve-wracking. But I'm going to kind of walk you through the steps and show you how you really don't have to be nervous about this. So let's go over to my trade platform here. And you can see, so I had a SBUX $92.50 $95 put. This thing had 31 days to expiration. I hadn't gotten out of it because it was at 100% loss. And for me, it just doesn't make sense to exit at 100% loss. Actually, it was more than that. It was like 144% loss because of all the volatility. So it doesn't make sense to exit it. It just makes sense to ride it out because you really can't lose more than 100% unless you panic and you exit the trade at 144% loss. You don't want to do that. You just let it ride out until either expiration or something like this happens. So as you can see, it's I now own 200 shares, which I was required to buy it at $95, which is just a small $35 loss, or $7,000 because I had to buy 200 shares, because if you do the math, that's a $35 loss. 35 times 100 is 3,500, 200 shares, $7,000, right? So the easiest way there's two ways to unwind a position like this. You can either sell your shares right back into the marketplace and then sell this put that you still own, because that's the beauty of a credit spread. You're protected. This is your insurance. I have insurance that says, hey, this option contract gives me the right to sell SBUX 200 shares at $92.50, right? So the easiest way to look at this is typically you can just sell your shares into the open market and then sell this put, and the difference between that transaction will be roughly the same as your max loss was when you calculated your put. So let me show you how that looks on paper. And actually, let me pause this video real quick so I can set that up. Okay, so this is basically how the spread worked out. So this is the original spread. So I sold the 95, 92.50 bull put spread. So let's just break that down by legs. So this is why the basics of options are so important. This is your foundation to knowing how to trade some of the more advanced strategies. So if we look, I did two contracts of this, right? So if we look, what this leg says is we sell two $95 puts. What does that mean? That means we're obligated to buy SBUX at $95 a share, which would be the equivalent of $19,000. But we also bought two 92.50 puts. And what does that mean? That gives me the right to sell SBUX at $92.50 a share, or $18,500. So the difference between those two is $500. Okay. So, you then take that difference, right? And subtract it from your initial credit. So when I sold those two contracts, I received on the front end $1.45 per contract. Multiply that times 100. That's $290. So that's the credit I received, $290. And what did I risk? My max risk would be the 500 difference here minus the credit received is $210. So if we go in, so we've now been assigned. So we just purchased SBUX at $95 a share, right? $95 per share times 200 shares is equal to $19,000. So that's what was just basically taken out of my account in margin. That's how it works. And don't worry about that. This is why you need a margin account, because you can trade credit spreads. My max risk was $210. I have a $10,000 account. I don't need the full $19,000 if I'm obligated. But you have to have a margin account to be able to do these transactions this way. Now, there's some people that might be trying to hang on to this, thinking, okay, if SBUX keeps going down, my put option will keep rising. But You change your risk parameters. So we don't teach you to do that. The best thing to do is to unwind the trade today. I'm not even going to fool around with it. I'm not going to try and take chance because the market futures are saying, oh, it's going to go up. But what if it doesn't? What if it drops even more? And what if I wait too long and my put expires? I'm stuck with 200 shares at $95, which is an all-time high for Starbucks. And if it's trading at $50 and it takes, a year and a half to come back, that's a real loss. Plus it's on margin. So I either have to dump that money in or I'm being charged. It's like a loan. So you don't want to do that. So we purchased it at $19,000 and we already know that we have the right to sell it at $92.50, which would give us $18,500 back. So we would lose our max loss of $210. So the easiest way to look at this is you can do one of two things. If you look at let's go over to my trade platform here. If we look at my trade platform, you see that it does a calculation for me already. It shows that I purchased at 95 and today, right now the mark is at 59.50. So it's showing me a $7,100 loss on my shares, right? So if I wanted to use option one, which is to sell the shares back into the marketplace and then sell my put, this put's got to be worth more than that. Because right now the difference is about $1,100. Well, it's $1,045. That's the difference. So I don't want that because $1,045 minus my original credit is going to be a greater loss than just exercising. So the easiest thing, I can't do it right now because the market's not open. It's only 8:40. But the easiest thing to do in the Thinkorswim platform is I'm just going to right click here and I'm going to say exercise. And what it's going to do when I click on that, you'll see up at the bottom, you can see it's going to exercise my shares at 92.50 and it's going to dump. So it took 19,000 away from my account. It's going to dump 18.5 back in. And then if you subtract out the 290 I got in credit on the front end when I placed the trade, I've lost $210. It's that simple. Don't play around with it. If your risk parameter when you set up the trade was a loss of $210, the way I trade credit spreads is I either take an 80% gain because I do a good kill canceled order on my trades and have them automatically sell off when or buy back to close when I get an 80% gain of that credit, or I just ride it out for a max loss. So I don't have to really, if I'm using a certain template to get in and out of the trade, I don't really have to do that. I just let it run. If I see it hit a max loss, then I just let it sit. So that's what's happened here. The market maker decided to exercise me because that's my obligation by selling an option. And I just simply unwind it like what I showed you here. You just do the math and this is the best way to, when something happens that you didn't anticipate or didn't foresee, just run the numbers, do the math, run it out on paper. If you're stressed out about it, find a mentor, find someone to teach you how to do this stuff. But the bottom line is, once you do the numbers out on paper, you'll see, oh, okay, this isn't going to be a problem. The only issue I could have here is because the market's been so volatile and we've seen some circuit breakers pop, I might not be able to get my trades in. But that's not really a huge concern for me because my put still has 31 days. So I don't have to worry about my put expiring, the one that I own. So, all right, so that's it. I just wanted to show you it's really not that big a deal if you're assigned on a vertical credit spread. This is you should know these things. If a lot of this didn't make sense, go back to the basics of options to know how they work. Remember, when you buy an option, you have rights. It's the most powerful position in options trading. And when you sell an option, you have obligations. It's the weakest position. It gives you cash on the front end, but it is the weakest position. A vertical credit spread, on the other hand, is a beautiful strategy because it has protection built in, just like I showed you here. So you guys take care. Hope this video helped, and by all means, leave a comment below. Give it a thumbs up. If you're not a member of our YouTube channel, please subscribe. We do videos like these all the time. So you guys take care. We'll talk to you soon. Okay, hey everyone. So I wanted to just kind of follow up or close out this video on the vertical credit spread, and I wanted to wait until my my exercise went through. For me, exercising my what they like to call the long leg, so selling back my shares at 92.50. It just took a long time. You can see it's 10.35. So it just took a long time because the markets are volatile. I talked about that in the beginning, but you can see this is proof. Everything I told you just went through. You can see here's where I was originally assigned, right? Bought 200 shares of StarBucks at $95. They took $19,000 away. And then I exercised my 2 contracts at 92.50, and you can see they dumped 18.5 back in. So everything I talked about in the beginning is correct. Now, if you take the math between 229 and what I have now, you're going to see that it's greater than that $210 loss. And that's just because I had another loss over here. When the market dumped, this was unfortunately all the trades I had out went from gains to losses. So that's what you're seeing. So my total account during this market crash, on this account, I lost $500 during this market crash, a $10,000 account. That's, what's that? 4%, right? That's about 4%. So while everyone else, and this is the beauty of what we teach in the Option Profit Formula Success Academy, while everyone else is probably, unfortunately, losing 23, 30, some people probably lost 40% of their account value. I had a buddy of mine that lost $8,000 on his 401k. It dropped by $8,000 in one day. I lost 4% of my account. I need a 5% return to get back to break even, and I have ways to do that. So anyway, the real point of this video was just to show you that that's exactly what you do. You unwind the trade by exercising your, that's how I did it. You can do it other ways if it's better to sell at the open market your shares in what it's trading for and then sell your put. You can do it that way. Sometimes they work out the same. In this case, it didn't. And it's, I'm not sure. That probably has a lot to do with the volatility. So anyway, that's it. You guys take care, and we'll see you in the next video.